So what we're going to switch to now is a conversation around financial accountability. What are 3 steps to financial accountability that a nonprofit could put in place? And as a baseline for that conversation, we're going to talk about the Jitasa approach and how we do it as kind of the guiding conversation or the structure going forward.
Thank you, Ron. So that was a great introduction to the rest of the topic that we're going to be discussing today. So I'm excited to share a little bit of time with you and give you some good tips that hopefully you can take back and basically put them into use with your organization. So Jitasa's approach, first of all, the most important step is to build. You basically want to build a really good accounting foundation in order to get the financial information that you will need to make decisions. We'll talk about how we're going to run it consistently, and then also about analyzing. You want to be able to take the information that you're not only have built upon, but run consistently, but then have the ability to analyze and make good decisions. And it's really important to invest in a solid financial accounting infrastructure in order to achieve your mission. Okay, so the very first step that we're going to talk about today is building. And you've got 3 critical resources in order to successfully build appropriately. First is your people. We'll talk a little bit more about people as we go along, but it's important to have the right people that are running your system. I know a lot of smaller organizations use volunteers, which can affect how effectively your system is being run. Your financial system itself should be flexible. It should meet the needs of your organization. It should be applied consistently. And there should always be checks and balances within your system. And then you also want to be able to pay attention to your document storage and retention. I find that's one issue with especially smaller nonprofits, that the retention of documents is an issue. So whether you scan them and put them online and keep them in the cloud, or you have your own personal filing system, it's important to maintain that, especially as you start to prepare for audits as you go larger. And then the final thing we'll also talk about is technology. Basically, at this point, a lot of nonprofits are using QuickBooks. Personally, at Jitasa, we use QuickBooks Online, and QuickBooks Online actually meets about 95% of most organization needs.
Mary, quick question. Is there any guidelines or best practices to how long you should maintain your records, receipts, and keep that stored?
Absolutely. So you want to always maintain your receipts for at least 7 years. Some people recommend up to 10. 7 is the guideline. Good question. Okay, so the first step that we're going to talk about is building the chart of accounts. So basically, the way we do it here at Jitasa is we make sure that your chart of accounts is aligned with IRS 990 requirements. And it's also aligned with accounting best practices and any funder requirements. And I know that, again, is an issue that I see a lot, basically because a lot of grants require additional information than maybe the 990 would, and it's very, very challenging sometimes to pull the information out of your accounting system in order to meet your funder requirements. So what I always like to try to do is create that chart of accounts that is basically meeting all those needs. Okay. So the benefits of a chart of accounts. So basically, again, it's going to provide the strong financial reporting. If you build it correctly, you'll be able to pull all the information that you need out of that. And you want to use an accounting system. I've seen people that, have still just a paper checkbook. A lot of people keep things on Excel. At bare minimum, QuickBooks Desktop, Peachtree, we have clients that use Fundeasy, so a more powerful system. I've seen lots of other systems like MIP, systems by Sage. So just it's important to at least use an accounting system to have the checks and balances.
And Mary, a question I often hear from nonprofit clients or nonprofits we talk to is, at what stage would I or, will I outgrow QuickBooks? So do you have any comments around, like, let's say the QuickBooks and like when should a company looking at a different system?
It's a good question. So QuickBooks can handle the needs of most, of all small nonprofits up to medium size. Once you start getting, in the millions of dollars, and a lot of it has to do with the number of transactions, the number of vendors, the number of donors. And so if anybody needs any more information about that, I actually can share some of that, offline. But it takes quite a while to actually maximize the use of QuickBooks.
Right, and we have several clients with multi-million-dollar budget that are still on QuickBooks, it's still sufficient and it can handle their needs, right?
Absolutely, absolutely. And the other thing about a chart of accounts is always to remember that there's a difference between the structure of a for-profit and a nonprofit chart of accounts. And again, mostly because of the fact that you want to use a class system and possibly even a location system with your chart. What you see with nonprofits is a lot of information is just within the chart and they're not utilizing other areas. So there are differences. And I do see a lot of times where a client comes to us and they're basically trying to track everything that they need for their organization within the chart without utilizing the other areas like a class structure. So just know that there are differences. Where we like to start is with what I call the UCOA. So basically, the National Center for Charitable Statistics published the Unified Chart of Accounts. And the link is here on the PowerPoint. And I do believe, Ron, we do share the PowerPoint afterwards, so you'll have access to this link.
Yes, it'll be posted on the Jitasa University website, which will provide a link to at the end. And you can actually view a recording and download the PDF version of the PowerPoint.
Perfect. Okay, so we're going to just review it briefly. I wanted to share with you what the basic UCOA looks like. So the first thing we're going to talk about is basically the statement of financial position, otherwise known in the for-profit world as the balance sheet. And so we're basically the first section here, sorry, let me go backwards, is the asset section. And so it's structured, again, just like a for-profit. You've got your basic assets, your cash and your accounts receivable, obviously contributions receivable, things like that. The next section is your liabilities, again, structured very, very similar in terms of your accounts payable and any kind of accrued payroll, accrued expenses, any type of unearned revenue. And the next section is the net assets, otherwise known as equity, and this is where it really changes from the for-profit section because the fact that we always want to keep track of unrestricted net assets and temporarily restricted net assets, and if you have any permanently restricted net assets. And then, of course, be aware that within unrestricted, there's lots of different designations in terms of you can have board-designated funds, and then under temporarily restricted net assets, you can restrict for use and for time. Okay. Next section we're going to show is the statement of activities, or otherwise known as the profit and loss. And again, here it starts to change just a little bit because you want to definitely separate your contributed revenue from other types of revenue. So first section here is basic support, and then you've got earned revenues, other revenues, so sorry, highlight it here as you go, and here's your other revenues, like your unrealized gains and losses, and then your personnel related expenses, so salaries, contracts out, and then non-personnel. And the last section is the non-GAAP expenses. And just be aware, non-GAAP expenses are things like recording volunteer time. So typically, organizations like to record the volunteer time on their books, but it's not for GAAP. So it's an area to record it, and then you would remove it if you are having an audit. Okay. So then what we do, basically, is we start with that large UCOA, and it's huge. So that was just kind of giving you a snapshot of all the different sections. And basically that UCOA is huge, and what we do is we take it and we modify it and we scale it for the organization that we are working with. So you can start with that large, scale it down, and make it much more, just have the ability to meet your organization's needs. And basically all of those lines within the UCOA are flexible. So you can adjust them, you can add to them, you can add more detail. One of the areas that different clients that I work with, you know, some like a lot of information on travel. You know, they want to track taxis, and they want to track, you know, parking, and they want to track, you know, hotels, and some just want a travel line. So there's ability to add and subtract. And then also the ability to apply a class system. And I know a lot of nonprofits, you know, when they first share the class system, say, well, you know, what are you talking about? But basically, you always want to be able to take every income and every expense and not only associate it with a line from your chart of accounts, but also associate it with whether it's a program, administrative, or fundraising expense. And so that's important to basically apply the class system in addition to your chart of accounts. Okay. So basically, again, it's really important to make sure that you're aligning all of those processes with your needs. Basically, that chart of accounts should allow for the audit to flow smoothly and adapt for any specific requirements that your organization would have. And again, just a reminder, that would basically apply to grant funding and things like that. And then here at Jitasa too, we like to educate the client, and that's important because again, there's so many different ways to look at the chart of accounts and things to add. One of the issues that we deal with a lot is people that are dealing with programs in different areas, and we actually can even add like the location tracking. So for us, we're trying to educate the client, we're trying to pull everything together, and we're trying to give you that structure that's going to meet your specific needs. Okay. So the next step after we have built that chart of accounts is now we want to run your financial system consistently. And so it's really important to be able to run it consistently in order to get useful financial information and accurate data out in order to make decisions. So one of the things I talk about a lot with clients is garbage in, garbage out. So if you have information that's going incorrectly, obviously it's not going to do you any good when the information comes out and you're trying to make decisions. It's important that you are reconciling your accounts. Each month you should be taking your bank statement and making sure that you've accounted for every transaction within your statement for the month. If you are using a donor management system, some clients like to reconcile the donor management system, with the financial system, depending on how those two systems are interacting. So always you want to reconcile. And one of the things that I've dealt with a lot with nonprofits is teaching people to close the books. It's really important to be able to, again, make proper decisions from month to month. And so if you have issued financial statements, so not only to possibly an executive director or to your board or your finance committee, then the next month, if the numbers from the previous month have changed, it's hard to make decisions. So once those financial reports have been issued, I always recommend closing the books. If there is something huge that comes up the following month that needs adjustment in the prior month, you can document it, you can talk about it, you can send that information along with the next set of reports so that, again, there's a flow of information in order to understand what's happening with the organization. So grant tracking is part of running your system. And this is an area that we'll talk more about in another webinar, but I wanted to briefly touch on this because it's really important for nonprofits to understand. Just remember that grant tracking, you have two types of grants. One is you're going to receive the revenue first and then report back on it. Others, you incur the expenses and then request reimbursement for it. And depending on the accounting system you are using, depends on how you track it. QuickBooks Online specifically is a great system for using because you can actually enter a budget, so you can track the actual expenses against what you expected those expenses to be. You can run reports specifically for the grant. That grant can cover various programs. It's a really wonderful system. So just know that there's different ways to run it depending on the accounting system you are using. The next notation there talks about requiring a third attribute. So again, if you look at like QuickBooks Online, you're going to have an account. So let's say you've got a travel expense. You're going to have that associated with a program. So, an art class in the Bronx is your program. And then you're going to have a third attribute, which is associated with a donor. So it's, donor A gave you $10,000 to run this program. So you can actually attribute that third level in order to track everything effectively. So again, remember your ultimate goal is to be able to pull a statement of financial position per grant. And so that's really important because you always want to be able to track your restricted funds. So if you have a grant specifically given to you for a specific program, you need to know at any point in time how much of those funds are left, how much of those funds have been released, how much of those funds are still restricted. Okay? So the final step to financial accountability, Jitasa's approach is to analyze. And so we always recommend reports. basically you all want to produce a monthly financial report, and that allows for effective decision making. If you don't have a monthly financial report, it's really hard, you know, to have reports that are sporadic during your year, and you can kind of watch trends as you prepare reports from month to month. So internal reporting. So the basic, like monthly reports that you want to do. So basically the executive director should understand your finances. So executive director should always see a set of monthly reports. Executive director, and if you have, accounting staff, should focus on cash flow. And again, in the nonprofit, this is really important, especially if you are grant dependent and you're watching as those expenses are incurred and when the next grant, funding is going to come in. You also want to review spending across categories. And this is one of those things that, for example, how much are you spending on program versus administrative? Or, are you spending too much to fundraise and the fundraising expenses are, in excess and you're not receiving as much money for that fundraising, venture. So always review spending across categories. And then you always want to look at giving trends. And this is an area that's been tough for the last several years. I've seen some organizations that are really struggling, and I've seen some that have been able to, actually improve their giving trends. So again, you're trying to look at what's happened in the past, and you want to look at those trends and kind of predict as you go forward, as you're trying to kind of focus on your cash flow.
So that's interesting, Eric, because it sounds like what you're saying is from a reporting standpoint, there's kind of three layers to that, right? The first one is to get a snapshot of where you stand today, right? And then the second one would be to maybe project where you're going to be. So with cash flow, like, is your cash balance, is it healthy? Do you have a nice run rate? Right. Are you going to be like 3 months from now, 6 months? Are you going to be at a healthy place? And then the last part is really around, I guess, like trend analysis and see, are you growing, decreasing in certain areas, and understanding what are the drivers for that.
Exactly.
Right? So if you have kind of that three-part view, I think it kind of gives you a nice, healthy look across your organization and a good understanding of where you stand and what you need to do to kind of respond or plan.
Exactly. And again, I find so much of the time that organizations, they have a set of reports, but they actually don't understand them, or they don't understand how to analyze them or to, make proper decisions with them. So you're exactly right. So those reports are really important to be able to predict all of that information as you go forward. The other is your board reporting. Now, if you have a very active board and they see reports on a monthly basis, that is wonderful. I always recommend that at bare minimum, your board should be reviewing reports quarterly. And I also recommend for your board that it's a little bit higher level reporting. You can provide the supporting detail if necessary or if requested. What I find a lot is boards can get too lost in the detail and not focus on the higher picture, which is what they should be doing. The internal reporting, executive director, accountant, bookkeeper should be focused on the details, but that board should be looking at the higher level. So reports to share on a monthly basis. These are the standard 4 that I like to present to the executive director on a monthly basis. So statement of financial position, otherwise again known as a balance sheet. I actually also like to do a statement of financial position that compares from year to year. I think it's a great picture to be able to see where you are now and where you were a year ago. Statement of activities. Same idea with organizations, but I love to do it by month because you can kind of see how you're doing by month, but definitely at a point in time and even compared to a point in time a year ago. Budget versus actuals is really important, especially as you're making decisions on how you're doing. Budget versus actuals, if you have, program people that are in charge of programs, so they can compare their actuals versus, the budget that they, initially expected. And then a statement of functional expenses. It's always important to keep watch on, again, the level of program expenses versus admin versus fundraising. So basically, the statement of functional expenses is a measurement of the nonprofit's efficiency. I love this little cartoon on here, the Robin Hood cartoon, so take a moment and look at that. But again, if you think, personally, if you are giving to an organization that you are aligned with their mission, you want to feel good that they are spending, the majority of that money running the program. Obviously, every program needs administrative costs, and obviously there's fundraising costs. A good ratio is 80-20%, 80% program. I've seen newer organizations, start down in the 60% range. Obviously the goal is to continue to grow and continue to try to spend as much of those donor funds on program as you can. So allocation of expenses. And this I have asked of me quite a bit on, what's the best way to allocate my indirect costs. So the rule of thumb is you want the methodology to be documented, you want it to be reasonable, and you want it to be applied consistently. I do have times where we are using one form of allocation and for whatever reason we decide to change it. And if you decide to change it, you document it, and then again you want to consistently apply it moving forward, and you want to have a reason for doing it. One of the most popular I see is based on employee time. So basically you're looking at your employees, how they've spent the time, which programs they've spent it to, you apply a ratio to that, and then you apply that ratio to your indirect costs. So remember, this whatever methodology is being used for allocation should be approved, obviously by the executive director. Most auditors want to sign off on it. They want to know how you're doing it. They want to know, how it's been applied. We get asked that quite a bit also. And then again, examples of allocated expenses, which would be indirect, would be things such as salaries, especially like an executive director's. Salaries typically has a lot of indirect, portion to it. Rents, indirect, office expenses. So here's just an example of a statement of functional expenses. I wanted you to see how it looks. So again, on the left-hand side is the chart of accounts, so contract services, non-personnel expenses, et cetera. And then those are allocated across admin, program, and fundraising. And then what I love to do on a set of reports is then to summarize that and use those percentages. So again, at a quick glance, you can see on my programs I'm spending about 70%, and my administrative costs are X, my fundraising costs are X. So I think that's just a good way to keep your functional expenses in line. And then you just always want to make sure you're analyzing it, and if you are not spending enough on program, or you need to review how things are happening, you can always correct it. And that's my my notes down below is, again, you're looking at your first half of the year, can we make changes so that by the time we're ready for our 990 or our audit, things are in line. And then again, review the methodology. Is it accurate for your organization? Should you be changing to something like a square foot, percentage? And then always take a look and make sure there's no, one-time circumstances that could be throwing your numbers off. So the next step here is talking about tracking budgets. So this is, again, one more layer in your financial reporting, process. So it basically is always giving you the ability to look to see where we started, where we plan to be versus the reality. And again, it's a really good management tool. And anytime there's discrepancies, you want to look into them. For example, I budgeted $10,000 for supplies, and I've now spent $30,000. Something's wrong. Or is that what something changed, and now I can document why it changed, or did something, in your accounting system get posted incorrectly? So any type of major discrepancies you always want to look at. And then if you actually have an expense where there's no budget, that's another kind of red flag, what's going on, why did this happen, is this a good thing? It helps you as you prepare, for the next year when you're getting ready to budget again, take a look at this type of information. Okay, and then finally, we're going to talk about the year-end activities. So again, if you've built it correctly, if you've run it consistently, now at the end of the year, you are ready to prepare your 990s, whether it's an easy or a full. Your accounting structure, if it's set up correctly, should be able to just basically give you those numbers that you can put on your forms. Obviously, you should be ready for audit. Again, it should all be set up so your auditor can, analyze just about anything. And then again, remember that strategic planning and the next step is working on the annual budget for the following year. Okay. So the annual budget process, so again, you've completed your year. Typically an organization starts this budget process before the year end, and they start working on the budget for the following year because the board needs to approve that budget for the next year. But it establishes credibility, it sets expectations. Obviously, you're providing a measurement tool for the next year. And then again, you want to ensure that you're emphasizing, the ratio of program spending versus fundraising expending and administrative. And then again, allows for increased cash management. So this is important as you're setting your budget. What are you expecting, to receive in grant money or donation money next year? Are you hiring any new program staff? Or are you elaborating on new programs that are existing? So again, things like that are all part of that budgeting process, so you can start to predict the next year as it comes. Okay, so best practices for creating your annual budget is, again, at bare minimum, at least budget, program, administrative, and fundraising. I'd love to see, each individual program budgeted, because I think, again, that allows for good reporting, good analysis. Is this program working? I spent, $50,000 on a program, but I served thousands of children. So I mean, it's things like that that allow basically greater analysis, greater decision making. At a bare minimum, again, you want to budget. I mean, you can budget for the whole year. I love to see budgeted on a monthly, quarterly basis if you need to. So the more detail or the higher level you can get into, the better, again, for making decisions, but at least start with a basic budget. And then you always want to set reasonable targets. So you want to look back. You want to look at your history. You want to think about what's happening going forward. Maybe it's salary increases, so you can justify, increases in that, or, you're expanding into a new area. So just always set reasonable targets, and then use a model as a sanity check. And again, Jitasa is going to be doing a webinar on a budget process, so stay tuned for that, because I know that's an important aspect.
And to add to that, one thing I found in the past when I ran different department functions for different organizations, during the budgeting process, like Mary mentioned, I'm a big believer, like she said, about projecting from prior history, but also justifying a change, both on the revenue and on the expense side. So on the expense side, if someone within my department was asking for an increase that was a large percent from below, like for example, if it was between 1 to 3% of an increase from last year, then that could be kind of like a standard allowable increase. But if they're asking for 10, 15, 20% for a particular area, then that requires a conversation, justification. Well, what's the rationale behind it? What's the return? What's the benefit? Let's talk about that, and then that may go through an approval process. And the same thing on the revenue side. I think prior histories are great gauge. So if you expect to, bring in 20% or 50% more from a particular fundraising channel, well, what's the rationale? What's the driver? What's the level of confidence that we can as an organization achieve that? Like, what's going to be different from this year than it was last year? It's going to be that we have more staff, or that we've been around for longer, people know us more. It's natural growth. So I think that kind of justification sanity check is a really good thing to put in place. And then to Mary's point, as you model it out, whether it's through QuickBooks, Excel, different tools, then you can really see how the different changes you make impact the health of the organization. Like if you were to, for example, lose this one channel and you don't hit that 20% increase that you expect, okay, well, what does that mean for your budget? And you can do some sensitivity analysis to see, how important are different assumptions, and what does your cash flow balance look like at different stages of the year if you don't hit some of your expectations.